Okay, good afternoon.
Good afternoon, sir.
Good afternoon.
Good afternoon.
Good afternoon, sir.
Good afternoon, sir.
Okay, so you are welcome to the 11 of our lectures or our online lectures. We're going to continue our discussions on the audit of historical information. Just that we're going to concentrate much on the audit of the group account, joint audits, and how to undertake a transnational audit. So if you are an auditor and you've been engaged to undertake a transnational audit, or a group audit, or a consolidated audit, how do you perform such work? So that's basically what we're going to discuss today. Now, before we move on to today's discussion, if you have a question on what we discussed yesterday, which has to do with the actual audits, the audit procedures to review and evaluate any item in the financial statement, just feel free and ask your questions. Like I said yesterday, or I told you yesterday, when it comes to the audit of any item in the financial statement, apart from the specific procedures, there are general procedures that you can apply to get the marks in the exam room. So make sure you know the general procedures that will be applicable when it comes to the audit of any item in the financial statement. Remember that irrespective of what you've been asked to audit, you're going to read minutes. And I told you that the minutes are three. You'll be reading meeting minutes of shareholders. You'll be reading meeting minutes of management and that of a board subcommittee in order to get evidence. And with the inquiries of management, you inquire of management around the topic that has been given to you to audit or review in the exam room. Then sometimes too, you have to obtain written representation of management. You need to inspect certain documents. You need to inquire of the lawyers. Sometimes inquire of other third parties. If it has to do with computation, you obtain copy on how it has been calculated, you recalculate, you check arithmetic accuracy on what you have been asked to audit. So please remember these general procedures. Anytime you hear audit procedures in the exam room, just apply the action verbs when you are writing it. Read, ask, inquire, observe, recalculate, reperform. Start with those terminologies. Are we getting it? We're supposed to start with those terminologies. Don't start with in the first place as auditor. Don't write a lot, please. Try as much as possible to summarize your points in the exam room. If you want to pass this paper easily without struggling so much, it's very, very easy to pass. And after Friday, or when we meet from next week, Monday, we're going to pick practical exam questions and discuss it, because by Friday, we will discuss the entire content of the advanced audit and assurance syllabus. Okay, so before I move on to the group audit, I want us to revise on the audit of going concern. So in the exam room, if you are given a question on the audit procedures on going concern, but before I do that, if you have a question, you can raise your hand, unmute yourself, and go ahead with your question. Any question for me before we move on? Okay, then let's move on.
Sir, please, I have a question.
Okay, Vida, go ahead.
I don't know if you have discussed quality control.
Yes.
If you can just refresh. Oh, okay. If you can just
discuss quality control. So,
okay.
I don't know. I'll check whether the videos are there. If it is not, then what I will do is that I have to do a recap of it. But I told you that with the quality control, we used to have international standards on quality control, which has changed, or it has been revised since December 2022. But for the purpose of IC exam, if you will be examined on quality control, you can still use the points under the international standards on quality control 1. But the revised one is the international standards on quality management. And I told you that the only changes in the old international standards on quality control 1 and the revised quality control management standards is just an introduction of 2 items, the risk assessment procedure, and communications, issues of communication and information given to the clients or the stakeholders in the company. Apart from that, it's the same thing. Quality control at the firm level, where you look at the entire audit firm level as general, and with the old standard, that is where we have firm and leadership responsibility. And under firm and leadership responsibility, I remember telling you that quality is supposed to be the culture of the firm. And it should start from the top to those down there. There should be individual responsible for quality control. And we expect that the person should be somebody at the partner level. And the person should have the skill, the ability, the experience to carry out the work. HR or human resource issue is also a quality issue in the old standard, but the new standard call it resource, which HR is also under the resources. But with the old international standards on quality control, we use the term human resource management. So please, by that, when we are doing general revision, I'll still talk about quality control issue, but we've discussed quality control extensively at the firm level and at the individual engagement level.
All right, thank you.
Okay, Adams.
Yes, sir. Sir, I want to see whether you can throw some more light on the detective risk under the audit risk, detective risk.
The detection.
Yes, sir.
Okay. So with the audit risk, I remember telling you that anytime you hear audit risk is a risk that you, the auditor, you express wrong audit opinion. The risk that the auditor will express wrong audit opinion. To expand it, audit risk is a risk that the financial statement will be materially misstated, and the auditor's substantive testing will not be able to detect that the financial statement is materially misstated. So what it means is that audit risk has to do with the risk of material misstatement and detection risk. Detection risk basically means your ability to detect that the financial statement is materially misstated. That is the meaning of detection risk. The auditor's ability to detect that the financial statement is materially misstated becomes a detection risk. Now, what will cause that? So your ability to detect that financial statement is materially misstated becomes a detection risk. What will cause that? Or how do you identify it in a case study? Please, number one is where you realize that the audit client has not been audited before. So let's say that you have not audited the client before. It can lead to a detection risk because if you have not audited the client before, what it means is that you don't really have understanding of that particular entity and its environment. And ISA 315 provides that in order to obtain risk of material misstatement, we need to obtain understanding of the entity and its environment. Understanding of our client and its environment is key in auditing. If you don't have understanding of your audit client and its environment, it becomes very difficult to audit those clients. When they are getting it wrong, you find it very difficult to determine that they are getting it wrong because you don't understand what they do. Typical example is that, let's assume you have not audited a financial institution before. You look at their financial statement and you see loans as part of their non-current assets. Generally, you might think that loan is a liability, but in a financial institution, loan is part of the assets. Therefore, you need understanding of the entity and its environment. So if you realize that your audit client is new, it's audit risk, and it can lead to a detection risk because you'll not be able to detect that they are getting it wrong. Number two, complex accounting transactions or complex application of IFRS in the client. Okay. So complex accounting transaction, that is where you realize that the client is into more financial instruments. The client is into more foreign exchange transactions. You know, these are complex accounting standard application. So when they get it wrong, it will be very difficult for you to detect that it is wrong. If you don't really understand the application of the IFRS 9, which has to do with financial instruments into detail, which is a bit difficult, you'll find it very difficult to realize that what they are doing is wrong. It can also lead to detection risk because when they get it wrong, you cannot detect that it's wrong. That is all about detection risk. Your ability to detect that what they are doing is wrong. Another one is where the client is having a very complex group structure. The client is a parent to 3 or 4 companies. The client who is an associate. The client who is a subsidiary to about 3 or 4 companies. And they are preparing financial statements. You find it very difficult to understand the group structure. Therefore, if they get it wrong, if management gets it wrong, you will find it difficult to determine that it's wrong. That is a detection risk. Please, are we getting it? Adams, are you okay?
Yes, sir. Yes, sir. I'm fine, sir.
So that's more of a detection risk. Your ability to detect that the financial statement is materially misstated as an auditor. Okay.
I'm
So let's look
grateful.
at how to audit going concern. So please, with the going concern, it is the responsibility of management to assess the going concern level of any company. Management are supposed to assess that a particular company is a going concern or not. So management will be using 3 indicators, which I told you that is also applicable when it comes to determination of business risk. Number 1 is financial indicator. So management will be checking the financials of the company. So if all the financials are showing negatives, it's a going concern indicator. So instead of net assets, they have a net liability. Instead of net current assets, they have a net current liability. Instead of positive cash flows, the cash flows are negative. Or the cash figures represent negative. It means that the company is not a going concern, or the company is suffering from going concern issues. Another indicator is the operational. So with the operational indicator, that is where you realize that the company is losing key management. The company is losing key suppliers. The company is losing their key customers. It tells you that the company is facing going concern problems. It's an indicator or operational indicator when it comes to issues of going concern. So you join a particular company as, let's say, NSP, and you realize that almost everybody wants to leave. It tells you that the company is not a going concern. And because the company is not a going concern, yeah, please, just a minute. I will be back. Just 1 minute. Okay, so please, sorry for the short IT related issues. I believe you can now hear me. Okay, so we're on going concern indicators. Please, can you hear me?
Yes, sir.
Okay,
Yes, sir.
yeah, we were on going concern indicators. Okay, and I told you that we have 3 indicators. I've raised 2 points. The first one has to do with the financial issues. The second one has to do with the operational issues. And the last one is the other issue, which basically deals with compliance issues. So if you realize that the company is not complying with the laws and regulation, it's a going concern indicator. So if the company is not complying with the applicable laws and regulation, it becomes a going concern indicator. Okay. If the company is facing any legal charges or any legal damages, it's a going concern indicator. Okay, so somebody is saying that he didn't get the second point. So 3 things: financial, operational, and the others. And the others have to do with compliance. And I'm saying that with the compliance, when you realize that your audit client is not complying with the applicable laws and regulations, it becomes a going concern indicator. So you realize that what let's say is a financial institution, Bank of Ghana has given guidelines for them to follow. They are not complying. There is a legal or court issues against the company. It's a compliance related issue. It tells you that your client is not a going concern, because if you are not complying with the applicable laws and regulations, what it means is that the regulator will come in one day, withdraw your license, and the company will cease to be a going concern. That is a compliance related issue. Okay, so 3 things: financial, operational, and compliance. Financial has to do with the financial statement. Operational has to do with the operations, where they are losing a particular market, where they are losing their key customers, where they are losing suppliers. Management wants to resign and go because they want to use, they are losing key management staff. It tells you that the company is not a going concern. So that is, or these are the responsibilities of management. Management are supposed to use these indicators to assess whether a particular company is a going concern or not. But we auditors, we need to also perform procedures to assess the reasonableness of the assumption used by management when it comes to going concern. Please, anytime you are asked to design procedures on going concern, review and evaluate going concern, just apply procedures on the 3 indicators. And it's not different from what we discussed yesterday. I told you that in any audit, you'll be reading minutes. You'll be reading minutes. So for example, if you're asked to audit going concern or review and evaluate going concern, you read minutes of shareholders meeting, discussing whether to continue the business or to close this down. You read minutes of management meetings, discussing some indicators of going concern or problems affecting the going concern of the company. You read minutes of a board subcommittee meetings, discussing whether to close down the business or to continue operating. So these are some of the procedures that you raised. So apart from reading of minutes, I told you that you can also inquire of management. So you inquire of management, whether they are losing their key management. You inquire of management, whether they have lost any market. You inquire of management, whether their suppliers are not ready to supply goods to them on credit again. These are all part of the procedures. The financials also require computation. So you obtain copy on how the items have been calculated. Then you recalculate it as part of the other procedures. Then you can also inquire of the lawyers, whether there is any legal damage or cause suit against the company. You can also inspect correspondence between the regulator and the company. Inspection of correspondence is also part of the procedures to get evidence on issues of going concern. So that is how we audit going concern. It's just like the audit of any item in the financial statement. I have already given you the technique. When you are asked to audit any item in the financial statement, it follows basically the same procedure. So please, for the purpose of this exam, if you are asked to audit any item in the financial statement, you should be in a position to audit the item in the financial statement. Good. Now, let's move on to group audit. Group audit. Group audit basically means that you're going to audit the entire group, the entire consolidated financial statement. So instead of associates, subsidiaries, and the rest, I'm going to call it components. So the components are within a group. Every component is supposed to have their own auditor, just like a subsidiary having their auditor. But the group auditor is responsible for the entire group. Okay, I will differentiate between group audit and a joint audit. For a group audit, the group auditor is responsible for the entire group, but each component within the group is supposed to have their own component auditors. And when it comes to the audit of the components, it is the responsibility of the components auditors. They are supposed to audit the components, but the group auditor audits the entire group. And the group auditor is responsible for the entire group. So please, when it comes to component group audit, what we're supposed to know is that if a component is a significant component, this is key. If a component is a significant component, the group auditor is supposed to be involved in the full audit of that particular significant component. But with the other components who are not significant components, the group auditor can just perform analytical procedures. And yesterday we discussed analytical procedures. The group auditor can just perform analytical procedures on the other components who are not significant components to confirm certain figures in their financial statement. They are not supposed to undertake full audits of those components who are not significant components. A significant component is a component which assets exceed or is more than 15% of the group assets. The liabilities are more than 15% of the group liabilities. The revenue of that component is more than 15% of the entire group revenue, or the profit of that particular component is more than 15% of the entire group profits. So if you have a component that is having more than 15%, or the profit level is more than 15% of the entire group profits, then that particular component becomes a significant component. And for significant components, the group auditor is supposed to be involved in the audit of the significant component, fully involved in setting up the materiality level and make sure they audit every single thing of the significant component. But if the component is not that significant, what will happen is that the group auditor will place reliance on the component auditors and undertake only analytical procedures on the audit of those components. But if the component is a significant component, please, the group auditor is supposed to be fully involved in the audit of that particular component. Good. So when it comes to group audits, if you are auditing any item in the group financial statement or the consolidated financial statement, the procedures there is not different from the general procedures in the audit of any financial statement, the same procedures. Just that for group audits, you have a lot of procedures because the component will have their management. The group will also have their management. So when you are making inquiries, you can inquire of the component management. You can inquire of the group management. So you have a lot of points to raise if you are given a question on the audit of any item in the group. You can also inquire of the group, the component auditors. You can also inquire of the component auditors. So with the inquiries, you have a lot of inquiries to make. If you want to confirm, you have a lot of confirmations to make, but it's basically the same procedures. With the reading of minutes, you can be reading management meetings of the components. You can be reading management meetings of the entire group. So please, you have a lot of procedures to raise when you are auditing the entire group. So if you are giving a question on the group, it should not be a problem for you at all. What it means is that you should have a lot of procedures to raise for the purpose of the exam. So the question is, who is a component auditor? Please, a component auditor is the auditor appointed by the group auditor to audit the components. So the auditor responsible for the audit of the components, or let me break it down. The auditor responsible for the audit of the subsidiary is a component auditor. You know, the group deals with a lot of components, a lot of subsidiaries. So if you are in charge auditing a particular subsidiary, what it means is that, okay, so if you are in charge auditing a particular subsidiary, it means that you are the component auditor. Gideon, go ahead. Please, Gideon, unmute yourself and then ask your question.
You were saying that the component auditor is an auditor who is appointed by the group auditor. So let's assume that, let's say the group auditor is situated, let's say, outside this country. The group is a group because they have a subsidiary in Ghana here. Then in Ghana here, the subsidiary has its own, let's say, auditors who have not been appointed by the group auditor. Does it mean that they cannot perform this group audit?
Okay, so they can perform the group audit. But normally what happens is that because the group auditor is responsible for the opinion on the entire group, because the group auditor is responsible for the entire group, even though management may nominate somebody, but the group auditor should be aware of that nomination. It's like you are working for the group auditor, even though you are on your own. Apart from situations where you are undertaking a joint audit where you and the other auditor will express joint audit opinion. So even though you are working there for on a particular component's financial statement, you are working for the group. And because you are working for the group, you are responsible to the group auditor, because the final opinion is supposed to be expressed by the group auditor. Because you are not on your own, you are working for the group. So somebody has nominated you to audit subsidiaries, or maybe management have engaged you. Obviously, we all know that before the group auditor will engage the components auditor, management should be aware of it. But the final audit opinion is supposed to be expressed by the group auditor. So the group auditor should be aware of the nomination of the components auditors. Apart from, we get to joint audit. And when we get to joint audit, you realize that for joint audits, the group auditor will be there, other auditor will be there, one audit firm will be there, and they will work together to express joint audit opinion. With that, they are all on their own. But when it comes to the audit of the group, even though you are on your own, you are working together with a particular group auditor, and the group auditor is responsible for the entire group. Okay. Yes to your question set. Loretta, please go ahead with your question.
Okay, please. So are we talking about the same audit company? Will it be the same audit company? Maybe let's say the same audit company has the group auditor and company, or different audit companies altogether.
Okay, so it can be the same audit company having a lot of, it's supposed to be different audit firm, please, Loretta. So for example, if it's one audit firm that has been engaged to audit and they don't have, let's say, a lot of branches across where the company is also operating, they need to have components auditors. They need to have auditors auditing the various subsidiaries. But the group auditor has been given the work. It's just like you have been given the work and you have nominated people to help you to achieve the objective. That is a group audit. So it can be the same audit firm or different audit firm, but supporting the activities of the group auditor. Please don't forget that when it comes to the audit of the group, you don't have, or let's say the parent company don't have 100% interest in their subsidiary. So obviously they may have their own audit firm. But once the work is given to you as a group auditor, you are responsible to express opinion for the entire group. Are you getting it? And because you are responsible to express opinion for the entire group, you need to check whatever the components auditors are doing. And we are saying that if a particular component is even significant component, you, the group auditor, should be involved in the audit of that particular significant component. But if the component is not that significant, you can allow the component auditors to be doing the audit work, okay? But you perform analytical procedures on the work that has been performed by the components auditors. You need, don't forget that you need the opinion to finalize your opinion on the entire group. You are solely responsible for the entire group, even though the components may have their own auditors.
Yes, sir. Please. So in a scenario where, let's say, an NGO, we have a project, but we have different partners, but we have a lead. So maybe one auditor audits the but we at the other partners, the same audit company, but I mean, they nominated different people. Would we categorize that as a group audit, or is that one is just one audit?
I think that one is just one audit firm auditing every your network. So please, if one audit firm is going in, it means that that particular audit firm who has been given the task to perform for the group level is a group engagement firm. But the components, the subsidiaries, are supposed to have their own audit firm. The audit firm of the subsidiaries becomes what we call the component auditors. That is the audit firm of the various subsidiaries. But what I'm trying to say is that with the components auditors, because the group auditor will express a final audit opinion for the entire group, the group auditor should be involved in the activities of the components. Because a typical example is a significant component. If a component is significant and the group auditor is not involved, don't forget that that particular opinion or the work there may affect the entire group level. So when the component is even significant, we expect the group auditor to be fully involved in the audit of that particular component. So the components may have their own audit firm, but the group auditor should be involved in the nomination of those components auditors. Or they should be involved in engaging them to perform such audit work for the entire group. Okay.
Hello, sir.
Yeah, please go ahead.
Sir, please, when it comes to matters to consider in accepting appointment as group auditor and that of audit planning of group audit, should we follow the same procedure or as the main audit?
Excellent. It's the same thing. That's the major reason why I didn't talk about it. It's the same thing. The same thing. The same acceptance procedures, the same thing. Usually I didn't talk about materiality and other acceptance related issues because it's not different from the individual audit. Okay, so please, you can put your hand down. So that is for the group audit, but let's discuss some aspects of group audits that may require some level of consideration. Typical example is where the components may have, maybe you have a lot of components, but the components may have different or coterminous year end. If the year end are not coterminous, what it means is that if they don't have the same year end, if the components don't have the same year end, the components, the parent don't have the same year end, how are you going to express your audit opinion? It requires consideration when you are auditing, or is an issue when you are undertaking a group audit. So for example, if the parent ends December, component ending June, or component ending October, how do you express opinion for the year? Now, with this, we can place reliance in the provision in the IFRS 10. So the standard provides that if the duration is 3 months or less, we can do adjustments to cover the other period so that you express the opinion for the entire year. But if it is more than 3 months, what it means is that you need another financial statement before the group auditor will be able to express opinion for the entire group. So if you have components who year ends are not coterminous, we don't have the same year end, it becomes when you're auditing the group. Another one is where you have changes in group structure. Okay, yes, Loretta, I think it's yes to your answer. Okay. Another one is where the group structure keeps on changing. That one too is an issue. So you are there and they are making additional purchases, they are making disposal of a subsidiaries, adding more to the subsidiaries and the rest. So when you are auditing the group, it becomes very, very difficult to audit the group. Then when you have overseas subsidiaries, that one too is very difficult when you are undertaking group or joint audits. For example, language barrier. You've been given the parent company is located in Ghana, you are auditing the entire group, and you realize that one of the components or one of the subsidiaries is located somewhere in China or any other country. Even understanding the language in the financial statement becomes very, very difficult when you are undertaking group audits. So these are some of the issues with group audits. And another issue that I want us to look at when it comes to group audit is sometimes the group management should issue what we call a comfort letter or a support letter. Please, anytime you hear comfort letter or support letter, it's a letter issued by the group management to support the component, because sometimes one component, when you assess it individually, you realize that the component will be having going concern problems when you assess that particular component individually. So the parent company should issue a support letter or a comfort letter indicating that they are ready to support the activities of the component so that the component will be able to continue as a going concern. So if you have a particular subsidiary or a component, and when you assess it individually and you realize that that particular component may be having issues of going concern, what it means is that the parent management should issue a support letter or comfort letter that will be able to indicate that they are ready to support the component to prevent the component from going on or having going concern problems or going on liquidation or wounding up.
So please, your line was breaking, so we didn't get the support letter.
Okay, so let me take the support. Wow, this internet issue, I have to face it. With the support letter, what I'm trying to say is that with a support letter, it's a letter issued by the parent management to support a particular component from wounding up. So what it means is that if a particular component left alone will have a going concern problem, let's say that you assess a particular component and you realize that that component will be having going concern problem, the group management or the parent management should issue a comfort letter or a support letter to indicate that they are ready to support that particular component from wounding up or having a going concern problems. So that's the purpose of the comfort letter or the support letter. It's issued by the management of the parent company, indicating that they are ready to support the components from going on liquidation or wounding up or having going concern challenges. Good. So that is a comfort letter. Briefly, let's look at joint audit. So joint audit is just like group audit. Joint audit is where two audit firms are coming together to undertake audit work, or more than two audit firms are coming together to undertake joint audit work. The difference between joint audit and group audit is that for joint audits, the two auditors will be jointly liable. They will be jointly liable. For the group audit, the group auditor is solely liable. That's the difference between the joint audit and the group audit. For joint audit, audit firm A, audit firm B are coming together to undertake joint audit work, and they are jointly liable. They will express the opinion together, they will sign the report together, and they are jointly liable. If it is a group audit, the group auditor will be liable. They are not jointly liable as compared to group audits. Now, let's look at what will lead to a joint audit. One reason why we need joint audits is situations of takeovers, where you want to acquire a new company. So the parent company may want to come with their audit firm. The target company or the new subsidiary too may want to come with their audit firm. So the two audit firms would have to work together to express joint audit opinion. Sometimes too for political reasons. So that is reason number one. Reason number two is for political reasons. Countries prefer firms to use their local audit firm to be able to express an opinion. So if the main audit firm is outside the country and you want to audit a company or a subsidiary or a branch in Ghana, the Ghana laws will require that the firm is supposed to be registered in the country. So what it means is that you need to work with audit firm established in Ghana, and the two audit firm will express joint audit opinion, and they are jointly liable. Another reason is, apart from political reasons, is where the company may want to use their own local accountants. Some companies may also want to use their local accountants when also performing the activities. So what it means is that the main company may be outside the country, or they want to enjoy external benefits, but they want to use their own local audit firm to audit them. So with that, external audit firm can take up the contract, but the external audit firm would have to work with a local audit firm in order to express joint audit opinion. So they have a lot of branches. One is outside, one is in Ghana. So they prefer that their Ghanaian accountants or their Ghanaian audit firms should audit their activities, whilst they also derive benefit externally. So the two firms would have to work together and express joint audit opinion. But the problem with joint audits is that for joint audits, it's very, very expensive because you have to pay more than one audit firm. So if you don't plan it very well, it becomes too expensive. Another issue with joint audit is the liability related issue, because the two audit firm will be liable. So what it means is that the negligence of one audit firm will affect the other audit firm. That's another problem with joint audits, because you are jointly liable. It's not like a group audit where the group auditor will be solely liable. With this one, the two firms are jointly liable. And because they are jointly liable, the negligence of one audit firm will automatically affect the other audit firm. So that is another problem with joint audit, or when it comes to joint audits. Okay, so that is for joint audits. Let me talk about transnational audits. Transnational audits. So three things: group audits, joint audit, and transnational audits. Group, joint, and transnational audits. Okay, somebody is saying that it can also be time consuming. Depending, yes, depending on how you explain it, it may also be accepted. Time consuming if you don't plan it very well. So whilst you are doing this, another firm too may be doing that, which will waste a lot of time. Yes, it's a good point. If you don't plan it very well, it becomes time consuming as part of the weakness or problems with joint audits. Okay. Now let's look at transnational audits so that we're able to differentiate between the three types or categories of audits: joint, group, and transnational. Transnational audits is performing audit work that will be relied upon in other jurisdictions. So you are here as a local audit firm, but your audit work will be relied upon in other jurisdictions. So whilst you are here in Ghana, auditing a firm in Ghana, you are okay. Somebody is also saying that it also reduced time. Please, it all depends on how you explain it and how you plan the joint audits. Good. So with the transnational audits, what it means is that you are here locally, but your audit work will be relied upon in other jurisdictions. So if you perform audit work that will be relied upon in other jurisdictions, it becomes a transnational audit. So typical example is that you are auditing an NGO and the NGO wants to raise finance in the US. What it means is that even though you are auditing the NGO here in Ghana, your audit work, the output of your work will be relied upon in other jurisdictions. The output of your work will be relied upon in other countries. That is a transnational audit. And as we all know, if you're undertaking any work that will be relied upon in other jurisdictions, we all know that the input, the kind of work, the quality should be different from when it's for local consumption. Even in our various institutions and investors, sometimes when you are requesting for transcripts, they ask you a question whether you are using it for Ghanaian institutions, that is if you want to upgrade yourself or you want to use it outside the country. So if it is for Ghanaian institution, they can even print any black and white and give it to you. But if it is international, it's supposed to be colored, it's supposed to be signed by some people and others. What it means is that the quality there should be different from the quality local. So if you're undertaking any transnational audit as an auditor, if you are performing audit work that will be relied upon in other jurisdictions, the kind of work should be different from when you're undertaking audit work locally. Now, let's look at the features of such audits. Please, for the purpose of this exam, sometimes the examiner will not tell you whether it's a transnational audit or not. You have to know it. So if you are given a question and the examiner tells you that there is this local NGO that wants to raise finance outside Ghana, and the local NGO has engaged your firm to conduct an audit on their financial statement, and the requirement will be, what type of audit work is this? What are the features? How do you prepare yourself to undertake such work? It means that the question is from transnational audits. A local NGO wants to raise finance outside the country, and they have engaged your firm. What type of engagement is this? What are its possible features? And how do you prepare yourself to undertake such assignment? Such work is a transnational audit work or transnational audit engagement. Okay, because your work will be relied upon in other jurisdictions. So if you're undertaking any work that will be relied upon in other jurisdictions, it becomes a transnational audit work. Okay, group audit is where you audit the group or the parent and its components. Joint audit, two audit firms are coming together to express joint audit opinion and they are jointly liable. Transnational audit is where you undertake audit work that will be relied upon in other jurisdictions. So if you're undertaking any audit work that will be relied upon in other jurisdictions, it becomes a transnational audit. So what are the features of a transnational audit? So if you are given a question on the features of such audits, what you need to say is that, number one, audit standards differs from country to country, or there are differences in audit standards from country to country. So the standards that we use in performing audit work in Ghana may be different from the standards used in performing audit work in the US. So if you're undertaking a transnational audit work, you need to understand that the standard locally may be different from the standard internationally. Now, we also need to note that, or as part of the features, we need to know that oversight and regulation when it comes to auditing differs from country to country. So the regulation and oversight that governs our audit work also differs from country to country. So we need to state that point clearly. Regulations differs from country to country. Then the last one is that there are also differences in auditing quality. So what it means is that the audit quality differs from country to country. The audit quality differs from country to country. So what we may call quality, audit quality in Ghana may not be audit quality in the US, because audit quality differs from country to country. So as an audit firm in Ghana here, you might think that you have produced good or quality audit work, but when you take it outside there, it may lack some features which may not be recognized as quality. So when you're undertaking a transnational audit work, or if you want to enter into a transnational audit market, what it means is that you need to understand that audit quality differs from country to country. Auditing standards also differs from country to country. Then the oversight and regulation when it comes to auditing also differs from country to country. Now, let's look at how firms need to prepare themselves to enter into a transnational market. How are we supposed to prepare ourselves to enter into a transnational market? Yeah, right, it will be sent on the platform. The manual will be sent on the platform. How firms need to prepare themselves to enter into a transnational market. If you want to enter into a transnational market, one, the firm should arrange to increase in size and capacity. So if you want to enter into a transnational market, you have to try as much as possible to arrange to increase in your size and capacity. It cannot be two-man audit firm and you want to take up a transnational audit assignment, because such work may require a lot of reviews. People would have to review your work. Therefore, you need to arrange to increase your size and also increase your capacity if you want to enter into a transnational audit market. That is number one. How are we supposed to prepare ourselves to enter into a transnational audit market? We need to arrange with other firms to increase our size and also increase our capacity. Number two, arranging to join the forum of firms, meaning the forum of the big firms, the big four audit firms. Try as much as possible to join the forum of the firms, the EY, the Pricewater, the KPMG, Deloitte, and Co. So if you want to enter into a transnational market, you need those people to support you to enter into a transnational audit market. Another one is that if you want to enter into a transnational audit market, you have to maintain proper quality control standards. So your quality control procedures at the firm level, at the engagement level, are supposed to be in place. So quality at the firm level, quality at the engagement level are supposed to be in place. If somebody is asking of the chapter as part of the audit of historical information. So try as much as possible and maintain proper quality control standards. So the quality at the firm level, the quality at the engagement level, what we discuss, firm and leadership responsibility, HR, performance engagement, monitoring, documentations, and the rest. Everything, the way you accept engagement and continue to work with a particular client. Make sure quality is a culture of the firm, and you should start from the top to those down there if you want to enter into a transnational audit market. Then the next one is maintaining high quality auditing standard. So if you want to enter into a transnational audit market, please, you should try as much as possible to also maintain high quality auditing standard, like the application of the international standards in auditing, the ISAs, is accepted by a lot of countries. So if you want to enter into a transnational audit market, make sure you apply the international standards in auditing in performing your work as an auditor. That is, if you want to enter into the transnational audit market. So that is what we expected to know under transnational audit, just the definition of a transnational audit, features of such audits, and how firms need to prepare themselves to enter into a transnational audit market. Please note that when you are auditing the group, every component will have their own component audit firm, okay? But the group auditor is solely responsible for the entire group, even though they have their individual audit firm, but the group auditor is responsible for the entire group. And if a particular component is significant, the group auditor should not think that because they have their own audit firm, they will place reliance on it. The group auditor should be fully involved in the audit of that particular significant component. Good. And for joint audit, I've already explained that. So please, it's question time. So if you have questions on what we discussed so far, feel free and ask all your questions. We are done with
Please, I
audit
have
of
a
historical
question.
information. So maybe tomorrow we're looking at government external auditing and the audit of the public sector. So when you are auditing the public sector, don't forget that you'll be undertaking audit of three things. You'll be auditing a performance, you'll be auditing compliance, you'll be auditing financials. And with the government external audit, we're going to look at how some regulators will be able to ensure public sector accountability. Okay, so some regulators in the public sector and how those regulators will be able to ensure public sector accountability. So these are the things that we're going to discuss tomorrow, like the Supreme Audit Institution. And in our case, the Supreme Audit Institution in Ghana happens to be the Auditor General's department, or the Ghana Audit Service, headed by the Auditor General. So somebody is saying that I should explain the comfort letter again. The comfort letter, what it means is that if you have a particular component and in assessing the going concern level of that component is having a going concern challenge, the parent management should issue a letter indicating that they are ready to support you to prevent you from going on liquidation or wounding up. Let me give you a practical example. Let's say that a university, a private university like Pentecost University. If Pentecost University is having financial challenges and GTech is saying that depending on their financials, they will not give them accreditation to run as a university. The church, Pentecost Church, even though the university itself, they have a going concern challenges because they don't have the money to grow and pay their lecturers and other workers well. But the Pentecost Church, because the church is fully established, the church management can issue a comfort letter or a support letter saying that they are ready to support the university to prevent the university from wounding up or going on liquidation. That is a support letter or a comfort letter. So that's a very practical example. Loretta, please go ahead with your question.
Yes, please. So, with the transnational audit, so in a situation like that, are the auditors supposed to maybe we are applying for a fund, a donor fund in the US?
Yes.
I mean, our financial accounts is in, I mean, we use IFRS in Ghana. So in that instance, would the auditors come and do another audit to suit the US, I mean, their requirements? And your answer, just this answer also gave me another question. With the Pentecost University, you know that the church is the church really audited according to IFRS and all that? So, I mean, can they use their standing as a church? Because I'm thinking that the church doesn't go through a formal audit. Maybe they'll have their own church audits, but it's not really required by law. Or if I'm right, if I'm wrong, you can correct me. But I mean, how would it
all right,
play out?
let me start from the second question. What I was trying to say is that if the university, don't forget that the university is for the church. If Pentecost University is for Pentecost Church, and GTech is saying that the university does not have a support, a financial muscle to operate as a university. But the church Pentecost is strong. We all know that for Pentecost, they take tithes, they take offering and other things. So they are strong to support the university. So what the church can do is that they will write a comfort letter or a support letter indicating that they are ready to support the university from wounding up or going on liquidation. Because you cannot say that the entire Pentecost church is also having going concern problems. You know, Pentecost Church is very strong, but the unit, or let's say the university in the Pentecost Church, may not be strong financially, or may be having going concern problems. So the church can issue a support letter indicating that they are ready to support the university. That is all what I mean by that. And with the transnational audit, what I'm saying is that the audit firm is in Ghana and they are auditing an NGO that stays or that work in Ghana, but the NGO is raising finance outside Ghana. So the NGO is here, but because the NGO raises finance outside Ghana or seeking for grants outside Ghana, what it means is that the audit opinion that you give as audit firm in Ghana here will be relied upon in other jurisdiction. What it means is that before the grant will be given to the firm in Ghana, the company there or the donors would have to look for the audit reports. And the audit reports should meet some quality. It should meet some future before the donors can place reliance on that particular report. That is all about transnational audit. You are performing an audit work, and the work that you are performing, you know that other people will place reliance on that work. That is a transnational audit work.
Okay, please, thank you.
Yeah, Anthony.
Yes, sir. Good afternoon, sir.
Good afternoon.
So can we then conclude by saying that with the comfort of support letter, it's from the parent or group to the component?
That is suffering, yeah.
Okay. And I also came across this thing, Transnational Audit Committee. Can you throw more light?
Okay, so with the Transnational Audit Committee, is the committee by the IASB, that is International Audit and Assurance Standard Board. And that committee is there to assess companies to undertake a transnational or enter into a transnational audit market. And like I said, the committee obviously will give you the guidelines if you want to go for if you want to enter into a transnational audit market. And as part of the strategies to enter into that market, I mentioned that firms need to arrange to join the forum of firms where the big four are, the Pricewaterhouse, the KPMGs, and the rest, if you want to enter into that market. So it's just a committee set up by the IASB, that the IAASB, International Audit and Assurance Standard Board. And they are in charge to help firms enter into the transnational audit markets. Okay, please, is it Lily? Will you go ahead with your question before we close, because it's exactly 1:03. Please unmute yourself and ask your question, Lily.
Yeah, so you said that you should join to join the big firms. To join the big firm, is it affiliation or just open that firm here? What do you mean by joining them?
Okay, so joining them basically means that you try as much as possible to increase your size, increase your capacity, and try and work hard so that you'll be part of the big four. Learn from them. That is the meaning of trying to join the forum of firms, trying to join the strong firms. You know, they share ideas, they share experience. So you have to try as much as possible and arrange yourself to be part of the big audit firms. That doesn't mean that you should be their subsidiary or you should be under them, no. Okay. So any other question? If we don't have any other question, what we have discussed so far is so significant in terms of the exam question, even though, to be honest with you, group audit is not popular in our exam room. Joint audit is not that popular. And transnational audit has been examined before, but not all that popular in the exam room. The most important thing is the audit procedures, identification of the business risk, identification of the audit risk in the case study. Try as much as possible and learn how to identify, even though we're going to solve practical questions next week. But with this knowledge, I'm very sure that when a question is given to you on audit of historical information, you should be able to do it. And we are meeting it for minimum 30 or 35 marks in the exam room. So we should try as much as possible and apply the strategies that we've discussed so that when the question is given to you, you'll be able to do it. So we're going to meet tomorrow to discuss government external audit and the audit of the public sector. And with the government external audits, we'll be looking at the role of some regulators in the public sector and how they can ensure public sector accountability. That is what you meet in the exam room for 10 marks. The role of the regulators in the public sector and how they can ensure public sector accountability. And the other one, which we will discuss tomorrow as well, is the public sector audit. They are all public sector. And public sector audit has to do with 3 things: financial, operational, and compliance auditing. And that one too is coming for 10 marks. So what it means is that what we're going to discuss tomorrow will be in the exam room for 20 marks. And I've been saying that issues relating to public sector is knowledge. Knowledge in the sense that just know the content, and once it's given to you, be able to do it. The role of the Auditor General, how can the Auditor General, the independence of the Auditor General, and the rest. Okay, so somebody wants to find out whether performance is the same as operational. For performance audits, we are talking about the audit of efficiency, the audit of effectiveness, the audit of economy, the value for money audits. Operational is broad, okay? So you are auditing economy, you are auditing efficiency, you are auditing issues of equity, you are auditing value for money. That is performance auditing. But we're going to have a detailed discussion on it tomorrow. Okay, so the types of audits, yes, as you mentioned, okay, yeah, that one is, I said performance, financial, and compliance. 3 types, just financial, performance, and compliance. In the public sector, we perform 3 types of audits: financial, performance, and compliance. It's not only financial. We undertake compliance audits, we undertake performance audits, and financial audits in the public sector. Okay, so our time is up. Thank you for joining. And we'll meet tomorrow to have a discussion on the public sector. So those who wrote public sector accounting, this is going to be more of a repetition for you because the content is not that different from what we have in public sector accounting. The functions of the controller, the audit committees in the public sector, the internal audit agency, internal audit unit in the public sector, and the rest. Okay, so thank you for joining. We'll meet tomorrow. Bye-bye for now.
Wow. Thank you.